Thanks for joining David, Kevin, and myself for the market update for the month of July. July was another solid month, third straight solid month, so we're all happy about that. The U.S. stock market, as measured by the S&P 500, was up 3.62% in July. The Canadian stock market, as measured by the TSX, was up 1.68% in July. And the international stocks, as measured by the MSCI EAFE index, was up modestly in July by 0.28%. David, what did the central banks do?
Well, both central banks in North America, the Bank of Canada and the Fed in the United States, decided to hold rates at their July meetings, citing sort of economic resilience. So things still continue to be pretty good as far as the labor market's concerned, corporate earnings. So things appear to be okay. There's still lingering inflation. And so they don't want to cut interest rates too quickly, especially in the face of the uncertainty of all these tariffs. I think the central banks, now that Trump has renewed some of these tariffs, the central banks want to keep some dry powder in the form of fiscal policy, so that if there is some level of economic slowdown in the second half of this year or into next year, that they still have the ability to cut interest rates to spur economic growth if there is any weakness. And so again, it's August 5th today that we're recording. On August 1st, Trump announced some more tariffs globally, including Canada, of course. So he levied a 35% tariff on Canada on goods that are not currently covered under the USMCA agreement. So this is pretty big news. He's fleshed out some other trade agreements with the EU and Japan and imposed tariffs on other countries ranging from 10% to as high as 41%. And so Canada is definitely at the higher range, again, on goods that are outside of the current deal. But the effective rate, because so many goods that cross the border are under the current USMCA deal, the current rate for Canada, the blended rate, is about 6%. And so that's certainly higher than it was before, but it's not totally unmanageable. And so at this point, it'll be interesting to see what Carney and Trump are able to sort of hash out. But it is interesting to note that Trump's continuing to cite the same old BS argument that fentanyl is crossing over the northern border in huge amounts, and that's part of the reason why he's imposing these tariffs. Meanwhile, we all know there's way more drugs and illegal things flowing through the southern border, through Mexico, into the United States, and yet Trump handed a 90-day extension to Mexico and their president, Sheinbaum. So maybe there's some better negotiating happening between Mexico and the U.S. versus Carney and Trump. I don't know exactly what the reason is, but clearly Carney's going to have to continue to work with Trump and figure out a way forward so that more free trade can occur between our two countries. How about corporate earnings last month, Harry?
Yeah, David, excellent question. Corporate earnings have been a lot stronger than we thought. Second quarter earnings, we expected a 2.8% increase. That was sort of the projected rate. We're on pace actually for 9.1% jump, which is huge. And as of August 1st, we've had 66% of the S&P 500 companies report, and 82% of them have beaten earnings per share estimate, and 79% have exceeded revenue expectations. This is the biggest beating estimates of growth that we've had in the last 4 years. So overall, earnings and growth rates have been a lot better than we've expected. And, if you look at a lot of the corporate executives, most of them have come in fairly confident that they'll be able to navigate the tariffs and be able to maintain, solid growth in the future, even though we do expect things to be a little tighter in the second half than they were in the first, David.
Yeah, and again, I think that harmonized or blended tariff rate at about 6% effective for Canada and the United States is, again, higher than it was. And, the average tariff rate imposed by the United States was about 2.5% in 2024. And now with all these tariffs that Trump has recently announced, it's jumped up to about 15%. across the board globally. So it is a pretty big increase. But again, a lot of corporations are going to be able to pass on a lot of that cost to the consumer. Now, again, the fear, of course, is that if too much is passed along to the consumer will stop buying because they can't afford it any longer. And that may have a negative impact on future earnings if corporations are not successful at passing along that added cost to consumers. So these are things that we'll continue to have to watch in the second half of this year and probably into 2026, because it takes a little while for these things to work their way into the economy, into corporate earnings and things of that nature. But as always, if anything, we've learned anything over the last 5 years, I think, Harry, since COVID, is that investment markets remain unpredictable. We don't know how policy can change from one month to the next. I mean, Trump could, as we've seen before, reverse course on a lot of these tariffs or hammer out more generous deals. Or he could reverse course, in 6 months, if the U.S. economy really does slow down because the tariffs are hurting the American consumer, he may pivot. Who knows? The other thing is that the Fed does have the ability to cut interest rates pretty significantly heading into next year, or later this year and into next year, with their rate still, in the 4.25 to 4.5% range, whereas in Canada we're at 2.75. So we've got a little bit less fiscal ammunition, if you will, from the Bank of Canada compared to what the United States has. And that's why in a lot of client portfolios we continue to be overweight to U.S. stocks, despite how pissed a lot of us Canadians might be with Trump and the tariffs and everything. As investors, you have to keep you should keep your politics separate from your investing. And we still want to own Canadian equities for a lot of portfolios, but we want to be more overweight to the U.S. still because of the fiscal ammunition they have and being able to lower interest rates still. And a lot of the best and most profitable companies in the world, as we're seeing this earnings season, continue to be headquartered in the United States. So as always, remaining invested, remaining diversified, remaining patient are all key attributes to being successful in investing.
Awesome points, David. As always, if you have any questions, if there's anything we can help you with, please don't hesitate to call. Take care.
Take care.